Welcome back to the Listing Talk podcast. Today, we're going to tackle a question that many of you have actually sent in. Is Standard Lithium a good time to buy now? Before we really get into this analysis of a company that's, well, stirring up a lot of conversations, we'd love it if you hit that subscribe button, like this episode, leave us a comment. Your engagement, it really helps us bring you more of these explorations. And hey, if there's a specific company you'd like us to look into, just let us know in the comments below. We've gathered quite a stack of the latest reports, financial data, market chatter, you name it, on Standard Lithium. Our mission here to pull out the most important insights, give you the whole picture really, and help you sort of cut through the noise, understand what's actually going on with this company.
Yeah, looking at companies like Standard Lithium, especially ones, right at the cutting edge in sectors like lithium that are moving so fast, it's rarely simple. They're in this space with just huge potential, but also, let's be honest, significant unknowns. We're going to try and peel back those layers, understand the critical bits that are shaping where they might be headed.
Okay, so let's unpack this. Standard Lithium isn't your typical revenue-generating giant just yet. They're focused on a very specific kind of cutting-edge area. For those maybe less familiar, what exactly is their core business?
Well, what's really interesting here is their focus on proprietary technology, specifically for lithium brine extraction. So this isn't like traditional mining. Think of these huge underground reservoirs of salty water, brine, that has lithium dissolved in it. Standard Lithium's process, their tech, it's designed to pull that lithium out efficiently, cleanly. Their big goal, the ambitious one, is producing battery-quality lithium carbonate, the stuff essential for EV batteries. And they've got a number, aiming for 22,500 tons per year for phase one of their project down in Southwest Arkansas, the SWA project. But the real moment everyone's watching, the big trigger, is hitting that final investment decision, the FID. They're aiming for the end of 2025. Getting that green light, that FID, would basically kick off their major commercial production. That could be really transformative for the domestic supply chain, especially with EV demand soaring and, the whole push to secure critical minerals.
That sounds incredibly promising, yeah. Potentially revolutionary even. But, okay, thinking like an investor, what are the biggest unknowns? Or maybe the technical hurdles that could still trip them up, scaling this proprietary tech? I mean, going from pilot to full commercial scale.
Yeah.
Every new tech faces challenges, right?
You've hit on a really critical point there. Absolutely. While the tech looks great on paper, and in pilots, the biggest question marks are really around, I'd say, two things: scalability and the long-term operating costs. Moving from a smaller demo plant to a full commercial facility, especially with a brand new extraction method like this, well, you can run into unexpected engineering problems. Costs can balloon. You might even find environmental issues you didn't see at the smaller scale. And, while their tech is supposed to be cost-effective, proving that out, at commercial levels, day in, day out, for years, that's the real test. Any significant delays, any performance hiccups there that hit their production targets, hit their profitability. So yeah, that FID, it's a really high-stakes moment for them.
Okay, it makes sense. So Standard Lithium has definitely kept the market on its toes this past quarter. Looking back, say, the last 3 months, July through September, what were the absolute standout moments, the shifts that an investor following this company really must know about?
Yeah, the last 3 months, July to September 2025, they were pretty pivotal. A lot of it was about laying that groundwork for the FID we just talked about. I think if you step back, the key takeaway from this period is how they've been systematically trying to de-risk the project, both through shoring up their finances and hitting some critical regulatory milestones. This isn't just, ticking boxes. It's about building a more solid foundation for what's ahead. So in September, they reported a really strong financial position. This was as of June 30th. We're talking $33.8 million in cash, $30.6 million in working capital. And for a company not yet making revenue, maybe even more important, zero debt. No debt obligations. That financial health gives them breathing room, runway for development without that immediate pressure of paying back loans. They also reaffirm they're pushing towards that FID for phase one of the SWA project, keeping that end of 2025 target for battery-grade lithium production firmly in sight. Then if you go back to August, their Q2 results, financial and operational, they offered some key technical validation. They reported their highest ever lithium concentration from the 616 milligrams per liter. Now think of that like finding a richer seam of ore, right? More lithium per liter of brine potentially means more efficient extraction down the line. And crucially, August also brought big regulatory wins. They got a favorable 2.5% royalty rate set by the Arkansas Oil and Gas Commission and a special project designation under an executive order 14241. These aren't just paperwork things. They're important government nods that can streamline operations and, crucially, give them more certainty on costs. And back in July, you saw the market react. The stock jumped up about 5.1% during that period. That reflected pretty clear positive investor feeling. And it wasn't random. It came right after those operational updates and the official approval for that new lower 2.5% lithium extraction royalty rate. That came through their joint venture with Smackover and Equinor. And that royalty rate, it wasn't just good for Standard Lithium, it actually set a really important precedent for other brine projects in Arkansas. It sort of signaled a supportive environment for this growing U.S. lithium sector.
You mentioned de-risking, and yeah, those regulatory approvals, they're huge for clarity and costs. I get that. But let's be direct here. For a company not making money yet, isn't the whole thing still inherently high risk? Regardless of a few early wins, what's the biggest remaining risk, the one that hasn't really been addressed yet, that maybe keeps you up at night, even with these positive steps?
Oh, absolutely. The inherent risk for any pre-revenue development stage company like this is still substantial, no question. These milestones, they're crucial, yes, but they address specific parts of the risk profile. They don't eliminate risk entirely. For me, the single biggest remaining risk, the one that really stands out, is still execution at scale. Okay, so the technology works in pilots, they've got approvals, but actually building and then operating a commercial scale plant, doing it on time, on budget, and consistently hitting the specs for battery grade lithium carbonate, that is a monumental task. You could run into unexpected geology issues, supply chain problems for construction, even just unforeseen glitches in running a continuous chemical plant. Any of that could cause major delays, major cost overruns. It's one thing to prove the science works. It's a whole other thing to master the large-scale industrial production side of it.
That makes perfect sense. So, okay, with those foundational bits sort of laid, let's look ahead. This is where it gets really interesting. For anyone watching Standard Lithium the next 3 months, October to December, seem packed with potential market movers, specific dates even.
Exactly. The upcoming calendar is pretty dense with events that could really act as catalysts. And these aren't just random dates, like you said. They're critical checkpoints the market's going to be watching very, very closely. First up, October 30th, that's their Q3 2025 earnings release. Now, for a development company, earnings aren't just about past profit, obviously. It's really a progress report. Analysts will be digging into it for updates on, well, how's the resource definition going? Any news on funding? What are the operating cost projections looking like? What's the cash burn rate? And crucially, have they kept that debt-free balance sheet we talked about? Any surprises there, good or bad, will likely move the stock. Then, November 18th, we've got a global lithium ETF rebalancing. Now, this might sound technical, but it can actually lead to more trading volume, more volatility for stocks included in these ETFs. If Standard Lithium gets a bigger weighting or maybe gets added to new funds, that can create automatic buying pressure, regardless of any news directly from the company itself. After that, December 10th brings the institutional 13F filings. For anyone unfamiliar, these are reports from big institutional investors, hedge funds, mutual funds showing what stocks they owned at the end of the quarter. It gives you a peek into what the big money is doing. Are they buying more Standard Lithium? Selling some. It offers a window into that institutional conviction, the overall market sentiment towards the stock, and then the really big one, potentially December 20th, an SWA Project Phase 1 FID progress update. This is the major milestone update. Even though it's labeled a progress update, any strong signal that the FID is on track, or even better, imminent, that will be a massive validation of their whole strategy. Could send the stock higher. But conversely, any hint of delays, any negative news around the FID, well, that could easily trigger a significant sell-off. Really highlights the high-stakes game they're playing.
Okay, so those are the knowns, the dates we can actually circle on the calendar. But then there's always the other side, right? The speculative stuff, the what-ifs that kind of fuel the market chatter and, let's face it, capture the imagination sometimes. What are some of those rumors? The more speculative catalysts floating around that could dramatically impact Standard Lithium, even if they're not confirmed yet.
Yes, the market whispers, where future potential often starts to take shape, at least in investors' minds. And while these are speculative, it's important to say that upfront they do reflect that broader, intense interest in securing critical minerals, especially lithium, and the potential value people see in innovative extraction tech like Standard Lithium is developing. These are definitely the kinds of things that could really accelerate the company's path, their valuation, but yeah, keyword is could. Unconfirmed. Okay, so one persistent rumor, you hear it a lot, revolves around strategic partnership announcements. We're talking potential deals, maybe with major battery makers or even large automakers. Companies looking to lock in future supply through what they call long-term offtake agreements. Imagine a big EV company committing to buy a large chunk of Standard Lithium's future output. That would be a huge vote of confidence, right? And it would basically secure the revenue before they even start producing. Another bit of industry chatter is around advanced technology deployment. Specifically, talk about potentially adopting proprietary lithium sulfide production techniques. Lithium sulfide is seen as potentially critical for next-gen solid-state batteries. If Standard Lithium could produce that directly, maybe more cheaply, that could give them a massive edge in the battery space as it evolves. And then you consistently hear analysts and investors kicking around the idea of takeout or buyout interest. I mean, in a world scrambling for lithium assets. Standard Lithium, with its promising tech, its Arkansas projects, it definitely looks like it could be an attractive acquisition target for a bigger lithium player. Or maybe someone trying to integrate their battery supply chain, wanting to own the raw materials. It makes sense as a target in this environment. And finally, maybe a bit more mundane but still important, is potential inclusion in more ESG or commodity indexes. If Standard Lithium starts ticking more environmental, social, governance boxes, or as their projects mature, getting into more prominent commodity indexes, that could trigger buying from thematic ETFs, funds focused on green energy or specific commodities, brings in a wider base of investors.
Okay, we've painted this picture of exciting possibilities, right? Upcoming dates, potential deals, rumors. But, potential doesn't pay the bills. We need to ground ourselves in the actual numbers, the fundamentals. So with all this buzz, what is the financial reality on the ground for Standard Lithium right now? What do the books actually tell us?
Right, and this brings us back to that crucial point about valuing a company that's all about future potential but isn't actually generating revenue yet. Standard Lithium, by definition, is pre-production, so zero significant revenue reported. In fact, they consistently show net losses. We're talking around negative $186 million recently. And negative earnings per share, EPS, about negative 0.97 cents. And Wall Street analysts, they expect this unprofitability to continue for a while, which, look, is totally normal for a company pouring money into building big projects like this, so financially healthy. Well, they are burning cash as expected to fund this development. It's very capital-intensive stuff. Historically, they've raised money by issuing new shares, equity financing. That strongly suggests there's a risk of future share dilution. Think of it like slicing up a pizza, right? Every time they need more cash, they might have to issue more shares, cut more slices. Your slice might get smaller percentage-wise, even if the whole pizza potentially gets more valuable later. Right now, their market cap is hovering around, say, $595 million, with about 204 million shares out there. Competitively, yeah, they're leaning heavily on that proprietary brine tech and their joint ventures like the one with Equinor. But, and this is the big but, that competitive edge. It's still unproven at commercial scale because they haven't started full production yet. So those losses, that cash burn, while typical for this stage, they really hammer home just how much capital these projects soak up and the very real funding risk investors need to weigh up.
That context is just so important, isn't it? So even with the excitement, we're looking at a company still very much in its heavy investment phase. Okay, let's pivot quickly to the technical side. What's the chart saying? How have the shares actually been moving? Are there patterns, signals traders might be watching?
Yeah, the technical picture for Standard Lithium definitely reflects that speculative buzz and the market's focus on the future potential. As of mid-September 2025, the price was around 2.90 cents. That puts it up near the higher end of its 52-week range, which was roughly $1.08 to $3.13. And actually, the stock gained about 6% recently, driven by those operational updates we talked about earlier, closing near that yearly high point. But, and this is key, it remains really volatile. That's pretty characteristic of these kinds of growth companies in hot sectors. Looking at specific price levels, technical analysts would probably point to a support area between, say, $2.70 and $2.80. That's where buyers have tended to step in before. On the upside, resistance seems to be building in the $3 to $3.15 zone. That's where selling pressure has often kicked in. Indicator-wise, the 50-day moving average, the SMA, that's around $2.72. Being above that often suggests some positive short-term momentum. The 200-day SMA, which is more of a medium-term trend guide, is way down at $1.83. So being well above that indicates a pretty bullish medium-term trend. The RSI, the Relative Strength Index, it's around 43, near neutral, really. Not wildly overbought or oversold, but the daily volatility figure is high, almost 6%. That tells you there are significant day-to-day price swings. High volatility means, well, expect potentially big moves up or down. It's definitely not a smooth ride.
Okay, we've covered a lot of ground here. The tech, the recent wins, what's coming up, the rumors, the financials, the chart. Let's try and bring it all together now. What's the consensus from analysts? And maybe more importantly, what are the big risks? The things you absolutely have to be aware of if you're even considering this company.
Right, putting it all together. Standard Lithium really is that classic high-risk, high-reward story. You've got multiple analysts out there with buy ratings on the stock. Their price targets, they range from about $3.23 up to $4.40. Now, that implies, potential upside of maybe 21% to 41% from where the stock was recently trading. That sounds pretty good, obviously, and it captures why there's excitement. So the key pros, the arguments for it, well, it gives you direct exposure, leverage to the booming lithium market, right? Which is critical for EVs, energy storage. You've got those strong analyst ratings we mentioned, positive sector tailwinds. And for traders, the technical chart has had a bullish tilt recently. But the cons are just as significant. You absolutely cannot ignore them. Zero current revenue, big ongoing net losses, all the risks that come with being pre-commercial, plus high volatility, that potential for more share dilution down the road to raise cash, and the fact that the stock price is super sensitive to news, good or bad, and just general market swings. And that leads straight into the core risks, stock specific. Well, no revenue means the whole transition to actually being a producer is risky and needs a lot of cash. Funding and dilution risk is right there with it, and project execution risk is huge. Can they actually build this thing on time, on budget, and make it work reliably at scale? Any delays, technical problems, failure to scale up, that could seriously hurt the valuation. Then you have the broader market risks. Lithium prices themselves can be volatile. There's always competition from new technologies popping up. And as an early stage company, it's likely to be more sensitive if the overall stock market turns weak. So, bottom line, those analysts' buy ratings, they're overwhelmingly based on the potential for future success, not the current financial reality. It really is a speculative play. It's best suited for investors who truly understand and are comfortable with the high risks involved in a pre-revenue company in a very dynamic commodity sector. The source material we looked at gives it an overall rating of 4 out of 10, and it explicitly says it's not recommended for traditional long-term investing, unless or until they actually start generating revenue and prove they can deliver on the project. For now, it seems more geared towards high-risk, tolerance traders playing momentum or sector news.
That's a really clear, balanced perspective. Standard Lithium is definitely a fascinating case study, isn't it? So here's a thought to leave folks with. Considering their big production goals and how much they're betting on their specific proprietary extraction tech, how might future breakthroughs in direct lithium extraction, maybe from competitors globally, either kind of validate what Standard Lithium is doing or maybe disrupt their unique path in the years ahead? And what does that potentially mean for the future shape of these critical mineral supply chains that are just so vital for where our economy is heading? Something to think about. Thank you for joining us for this insightful look into Standard Lithium today. We really hope this exploration into the sources helps you make more informed decisions for yourself. Until next time, keep learning, keep questioning, and happy investing.